Is diagonal spread hedging for beginners? Are you curious if diagonal spread hedging is a good fit for those just starting out in options trading? Let's break it down together. First, we need to understand what a diagonal spread is. A diagonal spread is a strategy in options trading that involves buying and selling options of the same type, either call options or put options. However, these options have different strike prices and expiration dates. This strategy combines aspects of vertical spreads and calendar spreads. So, how does a diagonal spread actually work? In this strategy, a trader will buy a longer-term option while simultaneously selling a shorter-term option. For example, if you believe a stock will rise, you might buy a call option with a strike price of $50 that expires in 6 months. At the same time, you could sell a call option with a strike price of $55 that expires in 3 months. The goal here is to profit from the difference in how quickly these options lose value over time. The longer-term option generally loses value at a slower rate compared to the shorter-term option. Now let's talk about how diagonal spreads can be used as a hedging strategy. Hedging is all about reducing risk. When you take a position that offsets potential losses from another position, you are hedging. In the case of diagonal spreads, you can use them to manage risk in your portfolio. For instance, if you own shares of a stock and want to protect against potential losses, a diagonal spread can serve as a hedge. However, to do this effectively, you need a solid understanding of options trading and risk management. Now, is diagonal spread hedging suitable for beginners? Generally, it is not recommended for those just starting out. Here are a few reasons why. First, the complexity of diagonal spreads can be overwhelming. They involve multiple components, such as different strike prices and expiration dates. This makes them harder to grasp compared to simpler strategies like buying or selling individual options. Second, effective use of diagonal spreads requires a good understanding of options trading principles. You need to be aware of factors like time decay, volatility, and how to manage strike prices. Beginners might find it challenging to balance these elements effectively. Third, diagonal spreads are sensitive to market conditions. Changes in volatility and time decay can impact the effectiveness of this strategy. Beginners may struggle to navigate these dynamics without prior experience. Lastly, diagonal spreads often requiring a directional view on the market, whether bullish or bearish. This can be tricky for beginners who may not have a clear sense of where the market is headed. If you are a beginner interested in hedging strategies, it might be more beneficial to start with simpler options strategies. For example, buying protective put options or using basic call or put options can be a great way to begin. Once you gain more experience and a better understanding of options trading, you can then consider transitioning to more complex strategies like diagonal spreads. In summary, while diagonal spreads can be effective for hedging and managing risk in stock trading, they are generally not the best choice for beginners due to their complexity and the need for a solid grasp of options trading principles.